What's up, you guys? I'm Dan. This is Frugal Not Cheap. I was recently helping someone with their investments, and we came to the conclusion that a target date retirement fund would be the best fit for her. That got me to thinking, this would be a really good topic for a video. So let's take a look at target date funds. Hey guys, so what are target date funds? Well, we're talking about target date retirement funds, and as the name suggests, these are mutual funds that are geared towards retiring at a particular date. In other words, you might have a 2040 target date fund or a 2050 target date fund, where those years are around the time that you're planning on retiring. They typically don't have a target fund for every single year, so you don't have like a 2041, 2042, etc. You're more likely to see like a 2040 and 2045. So you'd pick the one that's closer to your target date, or the one that's going to mean a better asset allocation, more suited to your preferences, and we'll kind of talk about that a little bit more later. Okay, so what exactly is in these mutual funds? How are they invested? And then how exactly does that target date come into play? Well, there could be some weird flavors out there that I don't know about, but the ones that I've seen generally hold both US stocks and US bonds, and then also international stocks and international bonds as well. For instance, here's the composition for the Vanguard 2060 target date fund. We can see that it's mostly equities, and the larger portion of that is US equities. Then we've got international equities. Then we've got some US bonds, and then international bonds make up the smallest component of the portfolio. What about this target date thing? How does that change the mix? Well, let's look at the Vanguard 2025 target date fund. So that would be intended for people that are retiring at or around the current year of filming. And we can see that this portfolio is much more conservative. In other words, there's a lot more bonds relative to stocks. In fact, 29% of the portfolio is in US bonds, just over 12% is in international bonds, and we also now have just shy of 8% in TIPS, which are Treasury inflation protected securities, so just another form of US bonds that do have some built-in inflation protection. Looking at the aggregate, we went from 92% stocks and 8% bonds in the 2060 target date fund to about a 50-50 split, 51% stocks and 49% bonds in the 2025 target date fund. So this kind of move from a more aggressive portfolio that's geared towards longer term growth but allows for more volatility to a more conservative portfolio that should see lower volatility but also likely lower future growth. This kind of move over time is what we might call a glide path. And in general, these target date funds follow that glide path from aggressive to conservative as we approach the target date of retirement. So that's one nice thing that these target date funds are doing for us automatically. Another great thing that they do for us over time is rebalancing. So if we were to do this manually, we would have to, periodically go in, look at our portfolio composition, and then have to do something that's actually psychologically difficult, which is to sell the winners, those that have been gaining a lot and now compose a larger share of our portfolio. We'd have to sell some of those off and then buy the losers, or the ones that have been lagging in performance and have therefore become a smaller proportion of our overall portfolio. And by doing that, we'd get back to our target asset allocation. We'd be back in balance. So of course, the target date funds take care of that. So they take care of their glide path, they take care of diversification, but they also take care of a lot of the decision making when it comes to, both how much US and international we should have, and then also which stocks to pick as well. So you may have noticed that there's a particular US international balance here in these Vanguard funds. That might differ a little bit depending on which provider's target date fund you're looking at. Like it might be different at Schwab or at Fidelity or what have you. But then you might have also noticed that all these funds within Vanguard are index funds. They're specifically market cap weighted index funds, which means we don't have to make any decisions about which particular stocks that we want to hold. Vanguard is making all those decisions, but actually it's the market that's making all those decisions because, again, they're market cap weighted index funds. And what this means, a great benefit to the target date funds, is we have a ton of diversification. Again, we have it across asset classes, we have it across countries, and then we also have it across bond issuers or across companies. So the total US stock market fund holds over 3,500 stocks. The international stock fund has over 8,700 stocks. The US bond fund holds 11,000 different bonds. And the International Bond Fund has over 6,500 different bonds. So you can see we have a huge amount of diversity here. So to recap, we don't have to pick any stocks ourselves. We don't have to pick our US international allocation ourselves. The glide path from aggressive to conservative is taken for us, along with the rebalancing as well. All of this sounds pretty amazing. Are there any cons? Well, there's always going to be some cost to kind of outsourcing all of these decisions and all of this work. And with some 401k providers, these costs could be quite significant. You might see expense ratios of 1% or higher. And that's always something to look at too. Like if your provider has expense ratios of over 1% for many of their funds, that's pretty steep in today's day and age. So if it were that case, I would invest. Personally, I would be investing up to the match in order to get that match, say even like a 50% match or 100% match on my 401k. That's going to be a huge return. It's going to more than make up for the 1% expense ratio by far. But anything beyond that, that's where I might consider, okay, does it make more sense to invest in an IRA or outside of this 401k because those fees are kind of excessive. The good news is there are a lot of low-cost providers. So I usually talk about sort of this trinity or trio of low-cost brokerages, which are Schwab, Fidelity, and Vanguard. At Schwab, for instance, the net expense ratio for their target date 2050 fund is 0.55%, which is not too bad, much better than over 1%. The comparable Fidelity fund has a slightly higher expense ratio of 0.68%. But when we look at Vanguard, they're the clear leader in terms of having a low expense ratio for these target date funds. We're looking at just 0.08%. Which is fabulous. It's a clear winner, and one of the reasons why I pushed my own employer to move from a different provider to Vanguard for our, retirement plan for the employees. They're not perfect though, and there are a couple of quirks here related to the target date funds for Vanguard that we do need to look at. One of these is that the Vanguard funds go very conservative within the first 7 years after the retirement target date. So in other words, for this target date fund that, has the year 2025, by the year 2032, that those holdings are going to become much, much more conservative, going from about 50-50 stocks and bonds, all the way down to only 34% stocks and 66% bonds. So essentially over those 7 years, they end up holding the same composition as the Vanguard Retirement Income Fund. So in my personal view, this is quite a conservative portfolio, and it could very well make sense for a lot of people and their personal risk tolerance. But for someone like me, it's definitely not going to make sense. So your mileage may vary. Now, what if you wanted to hold a more aggressive portfolio for longer? Well, you might have already thought of this easy solution, and that would be to basically just change the target date. So if I wanted to have a more aggressive portfolio throughout my time and my target retirement date was 2050, then I might choose a 2055, a 2060, or a 2065 one. And that would also mean that by the time I actually got to retirement at 2050, then I would have a longer time where the portfolio would remain more aggressive before that 7-year kind of move to 34% stocks would start to kick in. Another warning about, probably about target date funds in general, but this is an issue that came up with Vanguard specifically, when they changed the minimum investment for these funds. There were a lot of redemptions, and I don't know, it was a big fiasco where a lot of people ended up having huge tax consequences for the target date funds that they held in taxable brokerage accounts. So specifically, again, this is for taxable accounts, and all the people that held the target date funds in tax sheltered accounts like a IRA or a 401k, what's the other one, the thrift savings plan. Like those people were fine, but those that held these target date funds in a brokerage account, that became an issue. And in fact, Vanguard had to pay a settlement over $100 million. And more recently, I think there was an award for about another $25 million on top of that. So it was a big deal and definitely something to consider. Now, on that note, though, we come to another con of the target date retirement funds, and that's tax efficiency. So, we just said that because of those potential issues, it makes more sense to hold these in a tax sheltered account like a 401k. But that means that we're putting all of these assets, right, the US stocks international stocks, the US bonds, the international bonds, and tips, all within the 401k, and that may not be the most tax efficient asset placement possible. So that is one consideration. Now, I still think for most people, it's just going to be so much easier and make more sense and align pretty well with what they want to be doing to, invest in the target date fund in their 401k. And then, of course, they can dabble here and there outside of the target date fund in order to achieve their exact desired portfolio composition and tax efficient asset placement. They can kind of optimize a little bit outside of that if they wanted to. So basically here we're talking about another disadvantage of the target date funds, which is that they are cookie cutter. But again, there are ways that you could just kind of add positions around the target date fund or in different accounts in order to make it more tailored to your own personal situation. I mean, everyone's kind of situation, preferences, and all that is different. So can't provide any specific investment advice for any individual on this, just kind of giving the overall information as I see it. For me, kind of the main problem again is just how conservative these become over time. And so for someone that wants to hold a more aggressive portfolio, a kind of cool alternative is the Vanguard Life Strategy Funds. So these will essentially hold the same four things. You've got the US and international stocks, US and international bonds, and then what they do though is they hold a constant ratio of stocks to bonds. So like the Life Strategy Growth Fund will hold 80% stocks, 20% bonds. So it's very much like one of these, far out date, target date retirement funds, except again, they hold that same aggressiveness, throughout the time that you hold the fund. And that can make a lot of sense for some people. Basically, you're just eliminating that glide path that we talked about. So in short, and to summarize, I think that a low-fee target date retirement fund could be, a really awesome vehicle for a lot of people. Again, every situation is different. Consult a professional, yada, yada, yada. You know the drill, but I really do mean it. I mean, everyone, should make their own decision and everyone's situation is different. But this is quite a good solution. And many of the people that I worked with, when we start looking at their retirement, their investments, the target date fund is actually what many of them have ended up choosing for themselves. There you have it. That's target date funds in a nutshell. Hope you found this video helpful. If you did, please hit the like button and consider subscribing. Thank you very much for watching, and I'll see you in the next video.